Hi, it's Drake Briggs of City of Wisdom. Today we discuss the inflation impact you're ignoring right now. Inflation is sneaky. Everyone's talking about the price of gas or the price of groceries or the price of a trip. But there's one thing about inflation that we often overlook. And if we're not paying attention to this one thing, it can definitely be a challenge to our retirement success and throw our entire plan off track. And that is that inflation is not just a temporary inconvenience, right? It's a long-term challenge that eats away at our purchasing power, our ability to purchase the same lifestyle that we have year after year. That you can see that the price of things have gone up, that if you retired 5 years ago, it is possible that some of the things that you've been buying are 10 to 30% higher than what they used to be. And before we get into the, well, let's blame this and blame that, we're really just talking about the idea that inflation has been around for a very long time, that there's always something that changes the value of something else. And that if we have a bunch of money that you can even remember reading historically, even back in the day of the conquistadors, when they found all the gold with the Aztecs, the Incas, and the Mayas, they went back to Spain and they went and bought everything that was available. Where the gold that we were charging for these items, all of a sudden they found out I must not be charging enough because my entire store is empty. And then when we restocked our shelves, what did we do? Well, naturally we raised our prices because we're sitting here and saying, I must not have been charging enough, that there's still a lot of people who want to buy my stuff. And yet I'm completely out of inventory. That whatever I thought was the amount of gold, whatever I thought was a good price for gold, apparently I was wrong. So now that we put that on the shelf, that inflation has literally been around and it's going to continue being around, that there's probably like 10 factors that cause inflation, and it's not always the government, that there are a variety of things that can go on. Then when you take a look now, all right, well, that means that inflation, if it's always been around and it's still around, Dre, are you saying that inflation is a long-term challenge? And I would say, yes, of course, that is what I'm saying. Inflation is a long-term challenge that even if the price of something, let's say we're in historically high inflation, we just went through that, we're at a 40-year high, inflation was going crazy. Did the price of the items when inflation was back under control, did they go back to their original price? And I think we would all agree, no, Dre, they did not go back to the original price. Did they go down? Yes, they went down, but did they go back to the original price? You would say, no, they didn't go back to the original price. So what does that mean? Well, it's twofold. One is we're just talking about human psychology. And so you and me as human beings, that if I was getting, let's say, gas for $1 a gallon, and then the gas went up to $2 a gallon, I'm like, man, this is expensive. What's going on? And then if the price goes down to $1.50 a gallon, I have now anchored the $2 a gallon as my new anchor for the price of gas. So now I'm like, man, gas is on sale. That's a great price. And I just gave you the example of the gold that the conquistadors were bringing and introducing into their economy. Well, all of a sudden, when you're like, all right, well, I guess $2 is too high for gas, so no one's buying gas, I'm going to start lowering the price, right? Let's just say I'm going to lower the price because I need to sell the inventory that I have. Well, once you go down to $1.50 and you're now starting to sell out of your gas, what would you do as a business owner? You would do the exact same thing that the conquistadors did 1,000 years ago. And that would be, I'm going to stop lowering my prices. Whatever the demand is, I'm going to match that. That's just good old fashioned economics. So you and I, because the price used to be $2 and then it was $1.50, we feel that that's a sale. And so now we're purchasing all the gas on the shelf. Even though it used to be $1 a gallon, no one quite remembers the dollar gallon, or at least they've accepted it. And so I'll give you another example so we can look at the price of eggs. So we know that eggs are going up in price. I see people talking about eggs all the time. I eat eggs because I generally have a low carb diet. So I normally like to eat eggs. I just enjoy eggs. And I'm able to make a variety of different meals using eggs. So I see the price of eggs changing just as much as the next person. Well, what I'll do is let me share with you what the price of the eggs have been over time. And you'll notice that the price of eggs generally keeps going up. That we then have to have strategies to overcome. And I'll give you a handful of approaches that I believe will help you deal with the idea that inflation is a long-term challenge that you can never take a break from, that you always have to be considering and putting a plan in place to ensure that you beat inflation. And so in 1970s, what would you guess the price of eggs to be? Well, the price of eggs was 61 cents for a carton of eggs. And you're sitting there like, what, Dre? I know, right? 61 cents. In 1980, 10 years later, what would you assume happened to the price of eggs? You assume that they went up, right? Because everything goes up in price. We agree, which is why it's a long-term issue. It's not that Inflation happens sometimes and it doesn't happen other times. It's just sometimes it's really bad. And so we talk about it in the news, and then sometimes it's not really bad and we don't talk about it, but it's still happening. So in 1980, the price of eggs went up to 84 cents. 84 cents. And so we'll keep going. In 1990, another 10 years, the price of eggs is now $1.01. So you can see the price of eggs has almost doubled in 20 years, which would not be unreasonable for someone to be retired for 20 years. Which now, if we're looking at it from a long-term perspective, if I retired in 1970 and the price of eggs were 61 cents, and that's how I established my budget, that's the money I had generated and the income that I have. If I take my money out of the stock market, I'm no longer competing with inflation. It's just sitting under my mattress. Well, now in 1990, I cannot buy eggs anymore. Eggs are gone from my diet. That's completely out of the picture. And nothing has really happened except the price of eggs have now almost doubled. It's just from inflation. It's a long-term challenge that we really have to consider. In 2000, we got a break. The price of eggs actually went down. So it went from $1.01 to 91 cents. But that's still about 50% higher than what it was in 1970. And then in 2010, we lost. The price of eggs jumped up to $1.66. So if you look again, the price of eggs from 1980, where it was 84 cents, right? So I'm not even considering 1970, but 1980 where it was 84 cents. And now in 2010, it's $1.66. Again, the price of eggs have doubled. And then it went down a little bit in 2020. It was $1.51 for a dozen eggs. And now in 2025, I hear people talking about, oh, I found eggs for $7.99. And it was a sale. Go get your eggs. Where people are like, for me to get my free range, or is it cage free, the eggs that are brown, and apparently the chicken is being treated very nicely, that those eggs are $20 for a dozen of them. That someone said that the gas station had eggs for $9.99 for a dozen of them. And now you're sitting there like, well, wait a minute, Dre, mathematically, yes, you're right. That is literally 1,000% increase in the price of eggs. And so basically what we're saying that is, if you are not accounting for inflation in your retirement plan, what might appear to be a solid foundation in today's dollars, in today's economy, with today's costs, that it's almost like there's a small leak in the bucket of all of your money. That slowly over time, and the longer that we're living, inflation is draining that solid foundation of your retirement plan, unless we're invested in assets that can keep up and even surpass, in many cases, inflation. And what I'll do is I'll share with you 4 quick strategies that you can implement in your retirement plan to make sure that you are fighting the good fight, that you are winning against inflation. Number 1 on our list is you can invest for growth. So I'm always telling you guys that 65% of self-made millionaires have at least 3 streams of income. And because of that, it's important for us to be investing in asset classes that generate an income in your retirement. And so that's either going to be the stock market, which most of us are in, that your retirement plans and your employer, different things that are normally invested in the stock market. That is also going to be real estate. Many of you are in real estate, or you at least know someone that is, and it at least interests you. And the third one is a business. And so if you are an entrepreneur, you have an entrepreneurial spirit, or you know someone that's starting an idea where let's say like Steve Jobs comes up and he's like, I have this great idea, I'm just raising money for it. Are you in? Where you can give them money and then you're a silent partner. You don't actually run the daily operations. And as a result, you get to take advantage of that opportunity that was presented to you. That happens a lot of the time, or it's called private equity. It just simply means that it's not public, it's not in the stock market, where you have small networks where they can introduce these opportunities to you. If you're invested in those 3 asset classes, you have the ability to generate those other 6 streams of income that the IRS says that they recognize. The overarching economic principle of dealing with inflation is pretty straightforward. It's the idea that everything doesn't benefit everybody. That there are things that benefit me and will cost you. There are things that will benefit you that will cost me. And as long as we put ourselves in a position to benefit from inflation, then we're able to take advantage of the opportunity. So we're growing with inflation. We're not losing in spite of inflation. We're growing with them. Real estate is one of those opportunities. The price of homes goes up with inflation. The stock market tends to go up with inflation. That is baked into the cake. That if a business you're investing in is increasing their prices, that increases their revenue, which increases the value of the company that you've invested in. So normally those are going to be assets that outpace inflation. Same with your own personal business. If you have the ability to pass on the higher cost. Because if you don't have the ability to pass on the higher cost, all we're basically saying is, if I raise my cost, do people still buy my stuff? If the answer is yes, then great. You can increase your cost with inflation and you'll be just fine. If the answer is no, then you can increase your cost with inflation, which means you're increasing your cost then maintaining the same revenue, which means you're shrinking your margin. So you're generating less profit for your business. Well, that's not somewhere that we're generally looking to invest our money when we're trying to outpace inflation. And so continuing in our egg example, Waffle House has told everyone, hey, we're going to add an egg surcharge. You're saying, well, what, an egg surcharge? And Waffle House is like, yes, we're going to add an egg surcharge. So you're going to charge me more if my breakfast has eggs in it than what the menu price is? And they're saying, yes, I'm going to charge you more. Okay, how much more? We're going to charge you $1 per egg. You and I would say, wait a minute, you're going to charge me an extra $1 per egg on my meal, which obviously you and I would say that's not very exciting. I don't like the way that sounds. But from an investor perspective, you would say, okay, that means that Waffle House believes they have the ability to increase their prices with inflation, that we're going through an eggflation. So I should be able to increase my egg prices. And we'll see what happens. Right now, it looks like Waffle House is able to do that, that they're just fine. Did you see places like Five Below and Dollar Tree where they're dealing with inflation? And now the Dollar Tree, everything's not $1. They have some $5 items in there. They have some $1.25 items in there, but they don't have dollar items anymore. And you go to Five Below, they have things that are at $5. They have things that are at 3 at 2, but they have things that are at 10 and 20 as well. So it's not, everything's not below $5 anymore. So you can understand what we're saying when we're looking at these companies. Do you have the ability to raise your prices in inflation? And if you do that, somewhere that I know, if I invest my money, then I am outpacing inflation. So that's number one. That's normally a great place to start. Number two on our list is we want to plan for higher expenses. That if we're sitting here and we're saying, hey, you know what? I'm looking at the numbers, and based on historical averages, the price of healthcare has gone up 6% every year. But okay, what does that then look like for the life of my retirement? How much should I expect to have accumulated for my healthcare expenses? So if you're someone that's like, you know, Dre, I'm very risk averse, I'm not very comfortable investing in assets to keep up with inflation, that just means that we have to account for whatever the loss is. So if you're able to just keep up with inflation rate 3% in 3% inflation, I'm flat, Dre. Okay, fine. If you're flat where you're not generating enough to outpace inflation, that means that we have to have more money in the bag because we're just able to maintain a certain lifestyle. Now, if you're not even keeping up with inflation where you're literally losing 2% every year, let's say you have a 1% in the money market account or some CDs, or even I think I've seen some annuities that are like 1.5%. Well, that means you're losing money every year just before you even get started and spend 1 cent because inflation has decreased the value of your items. That if I was able to get eggs in 1970 at 61 cents, it's now 1980 and the eggs are, I think they were like 84 cents. Well, that means that I've already lost as far as my ability to purchase my normal lifestyle, which means we have to have more money inside of the bag. And normally what we'll do is we'll just simply take the money out and we'll say, hey, this is the lifestyle I want. We'll account for inflation, and then we just do like a present value calculation. And so I can give you an example real quick because, you know, we have to do this stuff. This is what's called a financial calculator, right? We have to do these. I probably could find one digitally online and then I can share it with you, be easier. And what we'll do is we'll say, hey, Dre, I'm having $50,000 per year that comes out for my investments today. How much money would I need to have the exact same $50,000 lifestyle in 20 years? And I'll say, sure, let's do this. What I'll do is we'll put in 20 for the N, right? So we're saying for 20 years, the interest rate is 3, so that's the I over Y. And so we'll place that for the 3. And then the present value is going to be $50,000, right? That is what I am living off of currently. And we're basically going to say the payment is 0, and so our future value is $90,305. So in 20 years, I would have to have $90,305 if the price of something that was $50,000 increased by 3% every single year. And so what you would do is you would then take that $90,000 and instead of saying in an income calculator, I need $50,000 every single year, you would just say, I need $90,000. And if you want to plan for 30 years, then you would kind of do the same calculation. You could probably go on Google and just type in, hey, what would $50,000 in 30 years with a 3% inflation? And it's going to give you the number. And then that's the number that you put into those retirement income calculators. Don't put in the $50,000 because we're not accounting for inflation. Put in that $90,000 and see how much it says you then need to have invested. And that's what the amount would be. And then you would go from there. So now my plan doesn't require me to invest in a way that outpaces inflation, which I do think is going to be the most efficient approach. But if you are someone that's like, Dre, I just can't, it just keeps me up at night, I'm very uncomfortable, fine. Then what we have to do is we have to take what the future income will be, and then we have to plan and generate the bag of money today that accounts for that. Your third option will be Social Security optimization. The cool thing about Social Security is it does go up with a cost of living adjustment. Now, it's not exactly one-to-one with inflation, but it does go up. So you don't have to cover as much. The question becomes, what do you want to do as far as bridging those years from 62 to 70, if that's what you're interested in doing? If that's what you're interested in doing, then we got to optimize your Social Security so that way you're not eating ramen noodles for those 8 years, but you can actually enjoy yourself, that you can have a nice retirement lifestyle, and then allow your Social Security to keep increasing by 8% as is currently projected. Okay? It's currently projected. I can't make any claims about the future, but currently it goes up by 8% every single year. And then it maxes out or caps out at 70 years of age. For most of you, your full retirement age is going to be 66 or 67, but you can get it as early as 62. And then the amount just kind of goes up from there. If you want to optimize your Social Security where it requires less of your money that's not tied to something that's beating inflation, then we can set it up everything from you and your spouse, where it's like, how much do you receive versus the spouse? Which one of you should take it early versus late? Or should you both take it early? Or should you both take it late? All these things have to be considered when you're doing a Social Security optimization strategy. In high level, it normally takes about 10 to 12 years for you to actually make back the amount of money that you did not collect for Social Security, right? So the idea is if I took, let's say you took out $1,000 at 62 and it would have been like 1,800 at 70. Well, that extra $800 is how much you're receiving in the extra benefit. Yes. But the cost was obviously you not taking the $12,000 every single year from 62 to 69. So we would add that amount up and then we'd see how long it would take for that $800 of extra income to replace that amount that you did not take. And for most people, that's normally going to be around a decade. So you would need to be very confident in your family health and your lifestyle and how you eat and all that stuff to be able to say, yeah, I'm very comfortable that I'll be here at 85. And I would say, okay, well, that would probably make sense for you as long as we have the income and the lifestyle and everything kind of already situated. But if you're like, yeah, Dre, our family history, I've had 2 heart attacks and this and that. I was like, okay, well, there's no reason for us to plan. I mean, I guess I can't really say that strongly. There's no reason for us to plan. I would say that we would have to strongly consider whether we need to wait for 70, because for you to make back that difference is going to take 10 years. And based off of what you're saying, I don't know the probability of success. You guys know I'm big on probabilities. I share the numbers that has an overwhelming likelihood of happening. That's the best way that I like to look at things, right? If 65% of millionaires have 3 streams of income, if 70% of people over 65 have 1 long-term care episode, that's the type of things I'm like, okay, that's a high probability, it's high likelihood of happening. So we should plan for it, or we should follow it, or we should avoid it, things like that. So we're sitting here, and if I was to say, hey, let's go fill out an insurance application, would you get approved? And if you wouldn't get approved, then that means that they don't believe that they have enough time to make a profit, right? Like, at the end of the day, that's all we're really saying. Insurance companies approve people that they believe have a low likelihood of dying early and a high likelihood of just being alive. And then we get insurance because we know that there's a low likelihood of me dying early, but we don't like the uncertainty of not knowing whether it will happen or not. And so insurance companies are like, sure, I'll cover that. And I think, and sometimes what we do is we share them, and there's like a risk assessment, it's like a 4 charts. And all you do is you take the likelihood and you take the kind of severity, and you create the 4 boxes. So you would say if it has a high severity where it's a huge expense, financial catastrophe, and it's a low likelihood of happening, then we would get insurance for that. If it has a high severity and a high likelihood of happening, we avoid it at all costs. If it has a low severity, right, it's not going to be that dangerous, and a low likelihood of happening, we just eat that, right? I'm not going to pay for insurance for my router. I know that they offer it because they're literally taking advantage of our fear of the unknown. But if it has a low likelihood and a low severity, then, I'm going to eat that, right? Not a big deal. If it has a low severity and a high likelihood of happening, then it's up to me to mitigate that risk. Like I should wear a hard hat if I work in a construction site, right? Like it's not that something will happen to me, but I should mitigate that risk. It's not going to be a huge severity as long as I have the hard hat on. And so that's normally how we handle risk and things like that. And so when we're looking at Social Security optimization, that is more or less how I attack it. Now, your approach may be different, but that's how I look at it. Financial planning is us really giving ourselves the highest probability of success. You don't want me guaranteeing you 100% of success because that normally means that you're paying more than you have to, right? And so I do want you to enjoy your lifestyle, have the efficiency, but I recognize that we're all different and it is your plan. I'm just simply your guide to help you accomplish what that lifestyle looks like for you. The final way of dealing with inflation is tax efficient withdrawal strategies. We know that we have costs, and sometimes those costs are things that we buy and get, and sometimes those costs are just taxes. And so when we're looking at cost cutting strategies, people are like, "Oh, I'm going to downsize. I'm gonna get an electric vehicle so I can save on gas. I'm gonna do all these different things." But we don't look at taxes. We got to look at the taxes, ladies and gentlemen. So we have to see if there is an approach that we can use. And every Thursday I do a live stream and I invite you to come to our retirement readiness Thursdays. And normally what I do is I'll break down a case study and you can see that giving someone a tax efficient strategy where we're able to not have all of our money in our 401k, which is fine for back in the day, but we're able to actually put some money in pre-tax, put some money in after tax, put some money in tax free. And then as a result, I don't have required minimum distributions to worry about. I don't have all my taxable income as ordinary income, that I have some capital gains, I have some tax free. So I've lowered my tax burden in retirement. Well, all of a sudden, I don't need as much money as I used to because my expenses also includes my taxes. And so if we are not very tax efficient, that means I need more money because Uncle Sam is taking more from me. But if I am tax efficient, I need less money because Uncle Sam is taking less from me. I'm maintaining the exact same lifestyle. You would look at yourself almost as your own business, where you have to have a plan where you almost look at your profit. What is my profitability? I have this much income, this much revenue coming in, and I have this much expenses. This is my margin of my profit, just as we've been discussing with businesses. You would be operating your finances as your own family business. And so we can look at it and say, do we need to increase revenue or do we need to decrease cost? Do we need to invest in certain assets and get a better ROI or other ones? And a lot of times, because our money is sitting in a 401k and a pre-tax account, all that money comes out as taxable income. But more importantly, you don't get to touch your money for decades. Like, think about that for a second. And Uncle Sam promises you no return, right? You still have to allocate the trades and manage it yourself. The only thing he promises you is what? A tax deduction today. So you invest the money today, no promises of growing, and then you get taxed at ordinary income when you take it out. That's a tough trade-off. It's not to say that I don't think we should use it. I do think that every financial instrument has a role and an opportunity to be very successful in our plan. And I'll put a link to a video where the live stream I did this last Thursday was building a tax-free retirement plan. But what I will say is if you were able to have a portion in your 401k and your pre-tax plan, and then you had a portion that was in a brokerage account, a very fancy way of saying just an after tax, Charles Schwab, Robinhood, Ameriprise and E-Trade, all those companies, those are just brokerage accounts. I just put my money in from my bank account and I could choose stocks and trade. Well, if I'm able to do that, or I can invest in a business with a portion of it, or I can invest in real estate with a portion of it, I now have the ability to tap into those income streams before 59 and a half without paying a penalty. Which, in my opinion, if the goal is to generate multiple streams of income, then we sometimes need to be able to move some of the income to generate that additional retirement stream. And if all the money is locked up inside of my 401k and I get penalized if I touch it, and there's no guarantees or returns of any kind, and sometimes the fees in your 401k are a little bit higher, then it really becomes a question of, is that the most efficient place to invest for my return on investment of purchasing my financial freedom? And I really do ask that. It's definitely a case by case basis, but it is a question that I ask, and it's a question that I encourage you to ask and think about in your own retirement plan as well. And hopefully what you notice is ignoring inflation now can lead to retirement stress later. The good news is having a retirement plan, a solid financial foundation in place, and using the wealthy retirement system, you give yourself the peace of mind of knowing I have a plan that adjusts with inflation, that I'm going to be okay, that my financial future is already set. I've used the strategies. I'm comfortable. I know inflation is happening. I'm not ignoring it. And I know that it is a challenge that isn't going away. It is relentless. It is always going to be knocking on the door every single year. The question is just how much, not if it's going to happen. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealth and retirement system. Until next time, stay safe and enjoy life.